Good morning. Today is Tuesday, April 16th, and there's two things that I want to go through with you today. The first trade I want to go through with you is the American Express trade that we've had on for just a little while now. If you recall, yesterday I had my initial stop loss was sitting right here where I'm drawing the red horizontal line. Remember, that stop loss was at 65.10, went long at $65.69, kept it really below this little, what I like to call a little ledge low, right? So look at obviously yesterday the market sold off big time, right? And gold got crushed, right? So obviously had my stops in place, no big deal. Market came down and knocked me out. I ended up losing 59 cents on that trade, no big deal. So I right now currently flat AXP, right, American Express, with a 59-cent loss. Okay, so now look at where the market stopped. It stopped at 64.09, right here at the hot pink 50 exponential moving average, the hot pink moving average right here that you see. So a quick 59-cent loss, no big deal. But the market looks like it might be setting up for tomorrow, possibly. We'll see. We'll see what happens today in the market. The market is up. We're getting that bounce. We'll see if it's a dead cat bounce. We'll see if the market comes back down to retest the lows. But I'm assuming we'll have a few setups tomorrow. But you know, if the market were to close right now, I'd have a setup right in here. Okay, I'd be looking to buy a penetration up through today's high. If today is an inside pattern, I mean right back to the 50 exponential. So again, we got stopped out with a 59-cent loss on American Express. No big deal. I'm keeping this on my watch list for sure. And the next one I want to go through with you is the British pound US dollar Forex currency pair. If you recall, we went short yesterday at 153.37 as it took out this low right in here, 153.37. We were looking for the market to come down in here. Our first objective was 152.62. Okay. Remember, our initial stop loss was up in here, right? We were originally risking 75 pips on this trade. Okay. Well, the market broke down yesterday pretty nice. We were looking for that 152.62 to get hit, right, before going to break even. Look at where the market went to, 152.69. We missed hitting that by seven pips. All right, seven pips. That's it. So this is what I'm going to do now. I'm going to go ahead and move my stop to above today's intraday high. Today's intraday high is 153.27. I'm going to go to 153.30. Okay, 153.30 is where I'm moving my stop. Again, 153.30 is where I'm moving my stop down to. So now I'm locking in. I'm only locking in 7 pips rather. Again, look at my initial stop loss sitting up in here. Market came down within 7 pips of hitting that first objective where it would then become a free trade. But what we see right now is, look at today's low, came real close within a pip or two of yesterday's low. I'm going to use today's intraday high. So if the market reverses and breaks up through today's intraday high, and look at today's intraday high is 153.27. So I'm going to go up to 153.30. I'm going to go right up above it, 153.30, above today's high. So that's where I'm sitting right there, okay? All right, the next thing I want to talk about is the general market. Okay, what you see up in here is the E-Mini S&P 500, right? So market got smashed yesterday, right? But you know what? We were long overdue for this correction, for this little one-day correction. We'll see if we get some follow-through to the downside. I would certainly expect the market to try to come back down and retest this low. But this is what I'm looking at and how I'm looking at it, okay? I want to measure from the year's low to the high. Okay, I'm going to measure the Fibonacci retracements. Okay, so I use TradeStation. So again, I simply click on here. Let's see. I simply click on the Fib tool right here, right? Fibonacci price retracements. When I click on that, I put it on the low and I drag it to the high. Okay, so I measured from the yearly low to the yearly high so far, right? The yearly high obviously is all-time high. And I also want to measure from this low to the yearly high. Okay? Now, if you take a look at those two swings, look what we have here. What we call Fibonacci confluence, right? Look at, if you, again, from the yearly low to the high, we got the 38.2% retracement right in here. And then when you measure from what I like to call an active low to the high, you've got the 50% retracement. Look at how the 50 and the 38.2 coming together right there. That's what we call Fibonacci confluence. So what I want to do next is I want to draw a horizontal, thick horizontal line where I think is a significant level. A significant level meaning if this level is broke, things may be changing to the downside for a while. But until this happens, you know what? We're still in an uptrend. We had a down day, okay? Big deal. Now, if you take a look at volatility, the only other time this year where we had a bar's range similar was right here. It's a pretty big down day, okay? Look at yesterday, very similar. So look at what we got. Okay, look at what we got. The day after, we had a small little inside pattern, right? Here, okay? So a big level here. The levels I'm looking at, really the low on the April 5th's low of 1533.25 and March 19th's low, 1531.75. 1531.75, if that's penetrated to the downside with a closer to a below 1531.75, then, you know, at that point we'd be breaking down through the 50 exponential moving average with a closing, you know, a closing daily bar below 1531. It would be at that time where I would say, okay, let's look to sell rallies. Things may be changing, but not until that is taken out to the downside. So let's take off the fibs just real quickly here, and I want to show you what happened after the last big down day. Okay, remember this down day I just showed you? Market came down, and look at that, we were real close to that 50 exponential moving average. Once the market took out the high the following day, right in here. Here, let's take this off. The market charged higher. So my trigger to get long 2 days after this big down day right here, right, we had another day with a lower high and a lower low. It was the next day when the market actually penetrated up through the high where we were going long. So I'm going to look for that same situation to occur. Okay, remember this day when the market was testing this low, couldn't take it out. Once the market penetrated through that high, that was the trigger to get long. Look at that run. So again, I'm going to look today to see what the market can do. If the market is an inside pattern, I mean, I would actually like to see the market actually trade lower today and try to retest yesterday's low, maybe take it out a little bit before potentially setting up for a long trade. But I'll let you know exactly what I'm doing and when I'm doing it on this market. So again, you want to measure your fibs from the yearly low to the high, and then this low to this high. And you want to pay special attention to these two lows, the 1531.75 and the 1533.25. Market starts closing below these levels, the market will start, at that point, would be breaking down through the 50 exponential moving average. So that's where we're at. Hope that helps. Have a profitable day. Bye for now.